New issuance has stayed relatively healthy and has actually been increasing over the last couple of years. The second would be market fundamentals are improving, and they're continuing to improve. We've seen NOI increases, we've seen unemployment come down a little bit. Peak vintage defaults have also already pretty much hit their peak. They started defaulting earlier, so therefore defaults should continue to level off for those. And if a loan has already survived through the downturn, then they should continue to survive at least through the term. The other is modifications have really been masking defaults, where we've seen a loan that may have otherwise defaulted, the borrower might be working with the servicer to cut a deal and either decrease their interest rate or maybe write off some of the debt, where they may have never actually defaulted, but they're not paying to their original terms. I think there is, although Fitch does still have a negative outlook for office properties. They tend to default after the other property types. They're a lagging sector where their leases are longer term, so therefore they might not see the consolidation and downsizing of the office tenants that you may have seen with a hotel or a multifamily property that marks to market pretty quickly. We are seeing those some markets that are actually improving. Technology sector, healthcare, those are typically doing a little bit better. Where we are seeing some weakness though is GSA tenants and the DC market in particular, where it's heavily concentrated in government tenants, and you're seeing vacancies increasing there. I think that they will continue to do modifications, especially where they see ultimate value in the property. There are some loans where they might have a lease rollover where the tenant or the borrower might need a little bit more time to release the space, so therefore the servicers are willing to work with them. Also, a lot of the borrowers are willing to keep the underperforming loans, and they might be willing to pitch in a little bit of equity on the back end of it. For instance, they might grant them a hope note with some promise of some equity from the borrower. The other issue with the modifications is those loans may not show as defaulted, and they may actually see a loss. So while we're not capturing them in the default study, we will capture them in the future loss studies.